Hello again, Internet. Welcome to All Things Canadia, the Canadian show not about hockey. My name is Yusuf Hanna, and today we're going to talk about Canada, specifically banking and financial institutions. Canada has been rated many times as having the safest and soundest banking institutions in the world. Canada won renown the world over for its handling of the late 2000s financial crisis and for avoiding the U.S. subprime mortgage crisis. Canada's fluctuations have not been as steep as the world's fluctuations. So when world output increased greatly, Canada's output increased, yes, but not as greatly. And when the world output decreased greatly, Canada's output decreased, but not nearly as badly. So what makes Canada so good at banking? Well, people generally look to the regulation of the banking system, but first we have to decide what financial institutions are. Basically, the three big ones that we're going to talk about today are banks, credit unions, and stock exchanges, and then the regulatory bodies that surround those. Banks, for the purpose of this video and for the purpose of regulation, is anything that accepts a deposit. So if there's an insurance company, for example, that takes a deposit, it's also a bank under these rules. There are three schedules of banks in Canada. The first schedule are domestic banks that operate within Canada. The second schedule are foreign banks that are operating within Canada under the Bank Act. They are recognized by the Bank Act. The third schedule are banks that are operating in Canada, but they are not recognized under the Bank Act, so they have more specific regulations on them. Schedule 1 and 2 banks are eligible to be insured by the Canadian Deposit Insurance Corporations, which insures deposits in Schedule 1 and 2 banks that are members of the Canadian Deposit Insurance Corporation for up to $100,000 each deposit. Now, how do banks work? How do banks make money? Banks aren't benevolent organizations that take your money, keep it safe for you without charging you anything or making any money. They run for profit. Where do they get that profit? You're about to find out. So, the way the banking system works is it's something called fractional reserve banking, which means that the bank, when it takes a deposit from you, let's say I put $100 in the bank, they're only required to keep a certain percentage of that $100 in the bank. That's called the reserve requirement. The rest of that money, so let's say the reserve requirement is 10%. The bank keeps $10 in the bank on hand, and then the $90 it can lend out. And it can lend out in two ways. One, it could lend it directly in a loan, and two, it can lend it directly into the stock market. So it would lend it to a corporation at an interest rate, or it's in a loan at an interest rate. The money made from the interest is profit for the banks. If credit were to be considered currency, the Canadian government only issues about 5% of Canadian currency, with the other 95% the credit being created by the banks. Interest rates and reserve requirements are set by the Bank of Canada to meet short-term policy goals. If you want economic expansion, you have low interest rates and low reserve requirements, which stimulates the creation of credit, which makes more money in the market. If you want economic contraction, you have high interest rates and high reserve requirements, which do not facilitate the creation of credit, which means there's less money in the market, which creates contraction. So now let's switch briefly to the idea of stock, because we mentioned it in the bank section, but we don't really understand what they are. Stocks is basically buying a share or an equity in a company or a firm. The three largest stock exchanges in Canada are the Toronto Stock Exchange, the Bourse de Montréal, and the Canadian Venture Exchange. The Toronto Stock Exchange is responsible for the trade of senior equities and most commodities, the Bourse de Montréal is responsible for the sale of derivatives, and the Canadian Venture Exchange is in charge of the sale and trade of junior equities. Senior and junior equities are pretty straightforward. You're buying equity in a firm. You're buying a part of the company, and they give you the profit that you own from that company. Most of the participants in the stock market are hedge funds and mutual funds and things like that, but there are a lot of wealthy people that participate in the stock market with their own money. The bank can participate in the stock market and generally does. However, it has to guarantee the amount in the bank for the people who have put money in the bank. Derivatives are very complicated financial instruments because they have no value in and of themselves. They derive their value from the underlying stock. The most common derivatives are call options, put options, and futures. Back to banks. Banks control about 70% of the country's financial institutions, and there are 5 banks that control 90% of the country's banking assets. The Royal Bank of Canada, Scotiabank, CIBC, the Toronto-Dominion Canada Trust, and the Bank of Montreal. These 5 banks have huge workforces in Canada and pay a combined about $4.8 billion in taxes every year. Now, the other 30% of financial instruments are handled in part by these things called credit unions, or in Quebec and New Brunswick, caisse populaire. These are run democratically and they're owned by the members. So the people who have invested in the credit union are the people who own the credit union. They get to vote for their board of directors, and the board of directors is what decides where the money from the credit union goes. Now, the board of directors has a vested interest in the money increasing because it's their money. Credit unions have had a bad name in the past because people believe that the only people who participate in credit unions are people who wouldn't be accepted by banks. But credit unions have been making a comeback recently, and the reputation has been growing, with over a third of Canadians being members in at least one credit union. So, how is the whole thing regulated? Banks and credit unions are federal jurisdiction, but stock exchanges are provincial jurisdiction. So, let's start with the federal jurisdiction because it's easier to follow. Banks, credit unions, and other federally regulated financial institutions are regulated by the Office of the Superintendent of Financial Institutions. The OSFI was created to boost Canadian public confidence in the banking system, and there's a whole bunch of number-based regulations that I know you guys don't like, but for those of you that do, I'm going to include a link in the description, that way you guys can see it, but I'm not going to get too into it. Basically, the point is they don't want a bank to fail. They regulate it so that the bank has to have exactly enough for it to continue functioning, because that's customers' money, that's people in Canada's money. On the other hand, if a bank does fail, it can be insured by the Canadian Deposit Insurance Corporation, which I mentioned earlier, and it'll secure deposits for up to $100,000. Now, in terms of securities and stock exchanges, each province has their own regulatory bodies for securities, and they're generally called the Provincial Securities Commission, so the Ontario Securities Commission or the Manitoba Securities Commission. It's very clever on their parts. Now, securities commissions have basically three mandates: protect investors from unfair, improper, and fraudulent practices, foster fair and efficient capital markets, and maintain public and investor confidence in the integrity of those markets. In addition to all this regulation, Canada is active in protecting its consumers from fraudulent practices. For example, recent regulation has made it illegal for telecommunications companies and airline companies to have hidden fees. The price you see is the price you pay. Also, Canada did not experience a subprime mortgage crisis in 2007 like the United States did, because they have the Canada Mortgage and Housing Corporation. Mortgages are assisted and regulated by the CMHC, and there's a minimum down payment and a minimum interest rate and a maximum amortization period that make mortgages payable. One issue, however, is that mortgages are traded as securities in an open exchange, and this might cause financial headache in the future. Thank you for watching. I hope you've learned something today. If you have any questions, leave them in the comments below and I'll try to get back to you as soon as I can. If you have any suggestions for future videos or comments about this one, please do the same. Internet, I'll see you next week.